Citigroup. Let's get stuck in.
In August 2020, the third largest bank wired $894 million of its own money to the wrong recipients. It meant to send $7.8 million. The same month, regulators fined it $400 million for the control failures that made the error possible. 4 years later, another $136 million for not fixing the problems fast enough. A customer's account was taken over. Password changed. Wire transfers enabled. 40,000 sent abroad. The bank called it customer instructions. The state attorney general sued. The first female chief executive of a major bank committed to a transformation in 2021. The original consent order remains active. The best flat-rate cashback card among the 4 major banks, and a 6-year pattern of denying fraud claims that the state's top law enforcement officer found serious enough to sue over. The modern institution was assembled through a 1998 merger that created one of the largest financial conglomerates in history. In 2008, it came closer to collapse than any of the other 3 major banks. The stock fell below $1. The government provided $45 billion in emergency capital and guaranteed $301 billion in troubled assets. At one point, the government owned roughly 36% of the common stock. The bank repaid by 2010, but the crisis exposed a fundamental question about whether the institution was too complex to manage. The answer came in October 2020, when the banking regulator fined it $400 million, not for a single scandal. For years of accumulated deficiencies in risk management, data governance, and internal controls, the bank had grown in complexity while failing to build the infrastructure needed to manage it. The internal data was unreliable. The controls that should have caught errors were inadequate. The accidental wire transfer of $894 million happened because the systems allowed a misconfiguration to send the full loan principal instead of a routine interest payment. Some recipients returned the money. Hedge funds kept $500 million, arguing they were owed it. The bank sued and ultimately recovered the full amount by 2023. The first female chief executive of a major bank was appointed in March 2021. 25 years at the institution, a consultancy before that. She committed to exiting 14 international consumer markets, cutting roughly 20,000 jobs, investing over $2 billion annually in technology and risk infrastructure, and simplifying the structure into 5 core businesses. By early 2026, roughly 80% of the transformation programs were at or near target. But the consent order from 2020 remains active. And the fraud reimbursement pattern the Attorney General documented tells a story. The transformation progress reports do not. In January 2024, the State Attorney General sued. The allegation was a pattern spanning 6 years. Customers whose accounts were taken over by scammers had passwords changed and wire transfers enabled. Money was sent abroad. When the customers reported the fraud, the bank denied reimbursement claims, characterizing transfers initiated by scammers as customer instructions. One documented case involved 40,000 sent internationally after an account takeover. The bank said the transfers appeared to have been made using the customer's credentials. The Attorney General's position is that if those credentials were stolen, the transfers are unauthorized regardless of how they appear. The lawsuit seeks reimbursement for all denied victims and fines of $5,000 per violation. A separate customer lost $12,000 through the peer-to-peer payment system. The bank characterized it as her own fault. She had authorized the transfers under fraudulent inducement. Multiple appeals denied. In 2023, the Consumer Protection Bureau fined the bank $25.9 million for discriminating against Armenian-American credit card applicants. The bank's systems had flagged Armenian origin as a fraud risk indicator, denying applications and closing accounts based on ethnicity. In July 2024, regulators fined it $75 million from the banking regulator and $61 million from the central bank simultaneously. The reason was insufficient progress in fixing the 2020 consent order deficiencies. 4 years into a mandatory remediation, the resources allocated to data governance were inadequate. In December 2025, the banking regulator withdrew the additional amendment, acknowledging demonstrated progress. But the core 2020 order remains active. A customer had a legitimate restaurant charge flagged as suspicious, the account was frozen, the fraud department could not complete verification through the mobile system, phone loops between departments, no resolution within days. The pattern across consumer reviews shows accounts closed for risk reasons, with balances frozen during review for weeks, resolved via mailed checks with no compensation for the delay. The products that work well at Citigroup exist alongside the weakest consumer banking infrastructure of the four. There are two banks sharing one name. The credit card business is genuinely excellent. The flat-rate cashback card at 2% with no annual fee is widely considered the best of its kind from any major bank. The rotating category card at 5% on the top spending category each cycle with no annual fee fills the gap perfectly. The travel card at 95 with 3 times on 6 categories, including restaurants, supermarkets, flights and hotels, completes what the community calls the trifecta. The points transfer program includes partners that enable premium flight redemptions worth significantly more than the nominal point value. For credit card optimization, no competitor among the 4 major banks matches this combination. The institutional business generates roughly 70 to 80% of revenue. Treasury solutions, trading, investment banking, corporate lending. The consumer banking unit that issues those credit cards and operates the checking accounts is approximately 15% of the business. The branch network is thin for a bank of this size. The savings rates are uncompetitive against online alternatives, earning 4 to 5%. The standard checking fee is $15 a month. The experience is consistently described as the distant fourth among the major banks. At 1 million or more, the private client tier provides genuine global banking capabilities with dedicated advisors, enhanced rates, and international access that domestic-focused competitors cannot match. The global institutional network covering Singapore, Hong Kong, London, and the Middle East serves customers who need banking continuity across borders. For everyone below that threshold, the consumer experience reflects a bank whose primary focus is institutional rather than retail, but the verdict depends on which of the 2 banks you plan to use. Citigroup is the right institution for 2 specific customers. The credit card optimizer, who wants the best flat rate and rotating category cards from any major bank, combined with transfer partners that unlock premium flight redemptions worth multiples of the point value. And the international client at 1 million or more, who needs global banking continuity across borders that no domestic-focused competitor provides. For those 2 profiles, no other major bank matches what Citigroup offers. But the 2020 consent order remains active 6 years after the $400 million fine. The State Attorney General is suing over a 6-year pattern of denying wire fraud reimbursement by calling scammer-initiated transfers customer instructions. $136 million was fined in 2024 for not fixing the problems fast enough. The bank discriminated against Armenian-American applicants using ethnicity as a fraud indicator. The branch network is the thinnest of the owns. 4. The savings rates are uncompetitive. The consumer banking is visibly underinvested. Keep the credit cards. They are genuinely excellent. Open your checking account elsewhere where the fees are lower, the savings rates are higher, and the fraud reimbursement policies are not being litigated by a state attorney general. Citigroup's transformation may resolve the consent order by the end of 2026. The chief executive warned in an internal memo against old habits returning. Whether the compliance culture survives the return to growth pressure is the same open question that applies to every institution in this series. The credit cards are the product. The checking account is the compromise. Every choice is a trade-off. At least now you know what you're trading.